Hello?
Yeah.
Sorry. Yeah, thank you very much for the introduction. I run an asset management firm and an advisory boutique in Tel Aviv focused on alternative investments and in particular on catastrophe bonds. So catastrophe bonds is a sector in financial markets focused on the insurance space, combining methodologies from capital markets, enabling investors gain the exposure to mainly natural disaster risks, and on the other hand, those who are interested to hedge, that is governments, insurers, reinsurers, corporates, to transfer this risk to capital market investors who are compensated by some fixed coupon. So therefore, those instruments are called catastrophe bonds.
So can you please dwell on that? What is really catastrophe fund, and what are the underpinnings behind that, and why there is this relevance to the insurance industry?
Absolutely. So going back 25 years ago to Hurricane Andrew that hit Florida, what happened back then is that the reinsurance capacity disappeared for a while and pricing has become very substantial. So essentially we had a situation where insurance companies and those who are exposed to natural disaster risks were not able just to find the proper reinsurance, that is a way to transfer risk. And what happened is that banks came and said, why don't we involve capital markets? There's much more capacity in the capital markets than in the insurance and the reinsurance space. And they've established a financial instrument called the catastrophe bond, essentially enabling investors interacting directly with those who are interested to hedge their natural disaster risks, transferring those risks to investors and offloading and mitigating those risks from the other side of this equation. These days, the size of the market is about 100 billion US dollars. Most of the capital is coming from real money, so pension funds, insurers, endowments, and essentially those who are interested to get exposure to uncorrelated risks on the one hand, and on the other hand, offer some protection to those who are in need of this protection. So the typical example of a catastrophe bond in the context of this forum, I think, would be catastrophe bonds issued by governments. For example, the government of Mexico, Peru, Chile, Colombia issued a bond offering to them protection against earthquake risks. And very sadly, one bond has very recently triggered, actually, or is very likely to be triggered due to an earthquake that occurred yesterday in Peru. So the way they work is very simple. Essentially, a certain predefined risk or a certain predefined set of risks are defined, like earthquakes, hurricanes, floods, etc. And if those risks materialize during the course of the life of the transaction, the issuer of the bond is getting the proceeds of the issuance. If nothing happens, i.e. if, let's say, during the course of 3 years there are no any hurricanes, no any earthquakes, the investors would get back their invested capital plus predefined coupons or premiums on this. So essentially, catastrophe bonds are utilized by those corporates, insurers, reinsurers, or governments who are very much exposed to natural disaster risks and need additional funding or need additional solutions to mitigate those risks. And the reason why pension funds and other money managers and those who are responsible for providing returns to the ultimate, the end investors are interested in this asset class has to do with the uncorrelated nature of these investments. Essentially, financial disasters or financial crises will never trigger a hurricane or an earthquake. Hence, the correlation of those instruments to mainstream markets is very minimal, making those investments very much attractive.
Can you please share some of the numbers in terms of the market towards catastrophe bonds that have been issued so far?
Yeah, absolutely. So at the moment, there are about 100 billion US dollars of outstanding issuances of catastrophe bonds. The average return of a catastrophe bond would be roughly 5 to 6%. Many of the sponsors are insurers, but also, as I've mentioned, governments are involved. The asset class is really increasing because A, there is supply, and B, there is demand. On the supply side, many of those who are exposed to natural catastrophe risks are employing this instrument as alternative to traditional reinsurance. There are a lot of advantages to catastrophe bonds comparing to traditional reinsurance. Typically, the investments are funded, i.e. the collateral that is going to be used in case of a catastrophe is being held in a trust account and can be easily withdrawn by the issuer in case that the catastrophe occurs. On the other hand, there's a lot of institutional money interested and exposed to the space. Just to give you an example, a Dutch pension fund, one of the largest Dutch pension funds called PGGM, just allocated or has been allocating around 4 billion US dollars only to this asset class. And in the context of impact or social investments, definitely this is a great candidate to tick all the boxes because essentially insurance is about helping, and especially catastrophe insurance is definitely a segment relevant in terms of its help to mitigate financial risks associated with very extreme events. So that's another angle that is commonly used when allocating to those asset classes. So many people are just attracted to this asset class because of the impact investing angle, and then also the risk-reward characteristics, which are one can claim in some cases are secondary to the first objective.
So I'm just trying to picture the whole instrument sort of in a way that so we can better understand it. So Turkey, the country we are at the moment, so it is prone to earthquakes, right, in many places. So let us try to assume that there is this insurance company which is quite interested in that, and as well as a number of investors are there ready to sort of purchase the instrument. How does it work? How does the process work? Very briefly, please.
Yeah, absolutely. So first of all, I'm happy to say that Turkey is actually involved in this space. The Turkish catastrophe insurance pool issued to date around 600 million US dollars of catastrophe bonds, protecting the pool from severe earthquake events. The process would be quite straightforward. The interested party would create a special vehicle that would essentially interact directly with the investors. This vehicle would offer a reinsurance contract to the hedger, the interested party in this, and at the same time would issue a bond. The money to support the issuance would come from international investors, including the pension funds I've just mentioned, and this money will be sitting in a trust account. If an earthquake would happen, the money would be basically wired or withdrawn by the issuer and used to pay claims or other purposes.
Okay, well, thank you very much, Tej. So another quite interesting product, social impact bonds. Can you please tell us